Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video we are looking at Terry Smith's portfolio. Terry Smith is one of those super investors that I genuinely like. He's British. He's very experienced in terms of investing in the basic stock market. He buys really quality businesses and hold them for a very long time. But before we do look at his portfolio, I just want to share with you guys some of his investment philosophy. He says, buy good companies. Okay, so basically focus on companies with high ROCE, good cash conversion, robust margins, and resilient business models. An ROC is return on capital employed, which is very similar to ROIC, which we basically would use in today's video and we always use. So he talks about buying a good companies. Then he says don't overpay. Okay, so no matter what you do, just make sure the companies that you're buying are not too expensive. Don't overpay whatever you do, and then absolutely do nothing. Hold it for a long term. Why? Because he believes the power of compounding and prefers to hold onto his investment for as long as possible instead of frequently buying and selling, which is really good. And that's what I've noticed in his portfolio. He actually adds a couple of companies here and there. But when it comes to fund split equity, if you check it out, majority of the companies that are in that portfolio of companies that he's basically investing in them, investors, they've been there for quite some time. So these are very simple. Buy really good companies, don't overpay whatever you do, and then just relax and just sit back. And that's what I'm going to try. Basically, I've been trying to do in the last few years, and I'm getting there. Now here and there I might make the odd sales because of certain companies, but I'm trying to. And there have been some companies that I actually bought and I've left them alone for a very, very long time. And I'm actually, inshallah, one day we'll get there. I'm not saying I am, as good as he is or anything like that. I'm nowhere near that. But at least that philosophy of basically buying good companies, don't overpaying them, and then holding on to them for a very long time really resonates with me. So what we're going to do now is share with you guys 10 companies in his portfolio that are Sharia compliant. So let's start with that one first. But before we get to the 10 companies, it will be absolutely amazing if you can join us in the Patreon account, where you get access to all the buys and sells that I make, the portfolio trackers, you got ETF trackers, you got the private Discord that is basically full of brothers and sisters who are sharing absolutely amazing practices, and then you got Sharia compliant investing ebook that's also in there. So it will cost you about 15p per day, and of course you get a lot of things out of it, as well as of course you can see my family portfolio inshallah as well. So as usual, we are looking at the same kind of things, but I've highlighted 3 sections. The first one is the moat rating, because every single company that he owns, or in this portfolio anyway, of Sharia compliant companies, they all have a wide moat. Return on invested capital, which is very similar to ROCE, basically also is quite high for majority of the companies, and they all have excellent free cash flow. So let's get started with the first company, and that's MasterCard. So the first company is a MasterCard, and as you can see here, it has a wide economic moat, 420 billion market cap. I'm not going to go through every single item here, but as you can see here, return on invested capital about 61% and free cash flow of almost $11 billion, which is quite nice. Total return the last 10 years is about 20%. Growth estimate next year 16%, and then 18% after that. So they are growing still. Their business is fairly valued right now. $475 per share is where they are. So they do have some paid excellent dividend, and of course the safety is actually really good. So again, profit margin, return on equity is really good, as well as return on invested capital. So these are the bits that I'm going to focus on in this video. I'm not going to read out all of them. Okay. Right, moving on to the next one. That's Automatic Data Processing, another company that I own in my portfolio. 99 billion market cap. It has wide economic moat. In terms of profit margin, we're looking at about almost 20%. Return on equity, we're looking at about 89%, and return on invested capital of 61% as well. Free cash flow, $3.3 billion. They're expecting the earnings to grow about 10%, 11% the following 5 years. Fairly valued, and then $240 per share is where they think the price should be. Now, of course, the company pays a nice dividend, and they have a dividend streak of 49 years. So that is a dividend king. One more year and they will become a dividend king. Kings are companies that have increased that dividend for 50 years and plus, and dividend aristocrats are 25 years and so. Next one is Zoetic. Zoetis. And this is one of the companies that we've talked about recently. 72 billion market cap. It has a wide economic moat. Right now, in terms of our profit margin, we're looking at 27% and return on equity of 50%, return on invested capital of 26%, $1.6 billion of free cash flow right now. And as you can see here, growth is actually looking good next couple of years, about 10% on average, fairly valued. $170 per share is where they think the price should be. Now, the next company we're looking at is Clorox. Clorox, I think, is a new buy because it wasn't there before. It has a wide economic moat, 18 billion market cap. This is one of the darlings of COVID. After COVID, the company, when COVID happened, the company went to the moon. And then after COVID, it actually lost quite a bit of the valuation. But right now, it's actually trading value, basically about discount right now. In terms of profit margin, we're looking at about 3% and return on invested capital of 500 plus. Return on invested capital, return on equity of 510, return on invested capital 27%. Free cash flow right now, just over $500 million. It's not great, but it's a very small. So in terms of $18 billion, that should be way higher than what it should be. But yeah, maybe they grow in their free cash flow again, maybe next couple of years. I'm not sure why he actually purchased the company, but of course it seems discounted. Maybe he sees that the company will come back to this good days, or maybe glory days, whatever. In terms of growth estimate, next year is about 14% and then 13%. Maybe this is the reason. Maybe this is, remember, this is a consumer basically stables company, and the fact that they're growing their earnings about 14%, 15%, 13% next couple of years, that's really good. And $169 per share is where they think the price should be. So it is an interesting company. Next one is one I own in the portfolio. I didn't actually know this. He owned this one, MSCI. It has a wide economic moat, about 36 billion market cap right now. And in terms of profit margin, we're looking at a 444 right now. And in terms of return on invested capital of 45%. I told you, a lot of the companies this guy owns, when it comes to ROCE or ROC and IC, they're actually doing really well. Free cash flow, $1.1 billion. And basically, they're expecting the earnings to grow about double digits next 5 years, which is really nice. Fairly value right now, $460 per share is where they think the price should be. Now, this is one of the companies that I own. I've got, I'm going to talk about in the next few weeks, and I've been buying it. And if you haven't seen my last video, go and watch that, where I talked about all the buys and sells that I've made for the month of April. Next one we're looking at is Home Depot, one of my favorite companies out there. 331 billion market cap, wide economic moat. Profit margin right now about 10%. Return on equity, we're looking at 1,162. Return on invested capital about 29% and $17.5 billion of free cash flow, which is absolutely wonderful. In terms of growth estimate next year, 7%, then 4% after that. 27% premium, so one of the most expensive ones that we've got in this portfolio, on this list of companies. $263 per share is where they think the price should be. Next one is Stryker Corporation. This is one of the companies that I really like. Before I bought Medtronic, I wanted to buy this one. But this one has always been expensive. As you can see, a 36% premium. I've not seen it basically undervalued basically ever. So 125 billion market cap, wide economic moat, profit margin of 14% and 18% in terms of return on equity, 15% return on invested capital, $2.8 billion free cash flow right now. And they growing their earnings double digits, but they are expensive. $242 per share is where they think the price should be. The next company we're looking at is McCormick and Company. Almost a 20 billion market cap, wide economic moat, and they have the profit margin of about 11%, return on equity 14%, and return on invested capital of 10%. I think this might be the lowest he's got in his portfolio. 1 billion market free cash flow right now, 7% in next year in terms of growth estimates. The year after is about 7.2, 11% right now premium, $67 per share is where they think the price should be. The next one we're looking at is Graco, whatever it's called. This is one of the I think we talked about this very recently, about $13.6 billion. Is a small cap company. When it comes to profit margin, we're looking at 23%, return on equity of 23%, and return on invested capital 24%, which is really good. $500 million basically when it comes to free cash flow right now, and they're expecting the earnings to grow double digits in the next 5 years, which is nice to see. Fairly value right now $78 per share. So we've got one more company, and I've got the Sharia compliance side of things to show you. If you have not pressed the like button, please do that already. If you have not joined us, the Patreon account, like I said, it will cost you 15p per day, and it will be really helpful for me and for everybody else. So Visa is the final company, 535 billion market cap, a wide economic moat. Where whenever you see Visa, you will see MasterCard. Okay. And look at this in terms of profit margin, 53%, return on equity, 45%, return on invested capital, 35%, almost a 20 billion free cash flow right now, double-digit growth expected next couple of years, fairly value right now, $260 per share, 268 is where it's at right now. So great companies, honestly, like I do own a lot of these companies, okay? And I'll show you exactly how much of these companies I own in a second, but generally these are really high quality businesses. They've been around for a very long time. They have a wide economic moat. That means they actually have a competitive, when it comes to their competition, is almost non-existent. Visa and MasterCard, of course, they are competitors, but they still grow in their businesses, slightly different business models, but they are competitors. Home Depot and Lowe's are very competitive companies as well, but Lowe's is not Sharia compliant. I really like Lowe's, but Home Depot, great company again. So I own 1, 2, 3, 4, 5 in this portfolio. So 5 out of the 10 that he owns. And as you can see here, they are this is where when it comes to Sharia compliant. As you can see, there are absolutely no issues with any of the companies. The highest one is this one here. It's about 26% when it comes to interest-bearing securities. Just to be honest and transparent with you guys, like I've always said to you guys, automatic data processing. I own 25 shares. My average is that. Okay. Next one he owns in the portfolio is Home Depot, and as you can see, that's my average for the company now. MasterCard is the next one, okay, and as you can see, that's my average. I'm down about almost 4.5% right now. Then it's MSCI. I'm down about 11%. There we go. That's my average for the company. And then we have Visa and SP as an SP Global. Was that included in there? I thought so. I thought it was included. I think he used to own it. I'm not sure, I need to double check that. I think he used to own this one. Why did I think he owned it? But anyway, Visa is the final company, and that is my average for the company. I'm up 25% right now, which is £874 basically up right now, which is nice to see. So there you have it. That's the 10 companies that this guy owns, and like I said to you guys, how high quality businesses, been around for a long time, wide economic moat, excellent free cash flow, return on invested capital really good. Some of them are actually fairly valued at the moment, and if we see a drop in the markets, I'm sure some of these companies will become discounted right now the next few months. Anyway, that's the 10 companies I wanted to share with you guys. As always, this is just a entertainment. Please, whatever you need to do your research, inshallah. Have a wonderful day. Assalamu Alaikum.